Okay, so imagine this for a second. You're on a deserted island, but it's a pretty nice one. You have food, shelter that works, but for your financial future, you're given a strange, irreversible choice. You can pick just one growth ETF to park all of your money in for the rest of your life. You can never sell, never rebalance, never second guess it. This is a true set it and forget it decision, but for your entire life savings. The stakes couldn't be higher. Which one do you choose? Well, this isn't just a game, it's a mental exercise that focuses to cut through the market noise and the hype. It makes us ask the hard question: what makes an investment truly last? What gives you aggressive growth but still lets you sleep at night? And ultimately, if I had to bet my entire retirement on a single ticker symbol, what would it be? Today I'm going to answer that question. We're going to put the two titans of the investing world, two heavyweight champions of growth, into the ring for a head-to-head battle. In one corner, the legendary Invesco QQQQ Trust and an icon of tech-driven aggressive growth, and in the other corner, the Schwab US Large Cap Growth ETF SCHG, the incredible, efficient, low-cost challenger that has been quietly delivering massive return. We're going to break them down across the only metrics that matter for a forever investment. By the end, you'll know which one I would trust with everything and the exact data-driven reason why. This decision could change how you think about your own portfolio. Before we meet our contenders though, let's talk about the elephant in the room. Why is this even a necessary question? Well, because as investors, we're drowning in choices. There are thousands of ETFs, each one screaming for your attention and your money. Growth, value, dividends, AI, robotics, international, the list is endless and frankly exhausting. This explosion of options has created a disease among investors: analysis paralysis. You spend hours, maybe days, watching videos and comparing charts only to feel more confused than when you started. One expert says you need to be in the hottest tech stocks to get rich, while another warns you that putting all your eggs in one basket is a disaster waiting to happen. The real villains here are complexity and the high fees that hide within it. They prey on our fear of missing out, promising secret formulas when all they really do is drain your returns over time. This leads to constant second guessing. Did I pick the right one? Is the other fund better? Should I just sell everything and switch? This churn isn't just stressful, it's terrible for your long-term wealth. Constantly buying and selling racks up costs, creates taxes, and worst of all, it stops your money from doing the one thing it needs to do to grow: compound uninterrupted for a very, very long time. And that's the problem we're solving. We're looking for an escape from the noise, a simple, powerful, and reliable solution. Just set it and forget it. Promise isn't about being lazy, it's about being smart. It's about finding an investment so fundamentally sound that you don't need to tinker with it. It's about building a financial foundation so strong it can withstand any storm. So to find our one ETF forever, we have to start with the best. In the world of large cap growth, two names constantly rise to the top. Let's get to know our fighters here. First, in the blue corner, with a staggering market cap and reputation that speaks for itself, we have the Invesco QQQ Trust, ticker QQQ. If you've heard of growth investing, you've heard of QQQ. It tracks the Nasdaq 100 index, which is the 100 largest, most innovative non-financial companies on the Nasdaq exchange. Think of it as the all-star team of American tech: Microsoft, Apple, Nvidia, Amazon, Meta. For decades, QQQ has been a go-to for anyone wanting to make a powerful, aggressive bet on the future. When tech is booming, QQQ doesn't just climb, it soars. It's the undisputed champ of aggressive growth. But as we'll see, the aggression comes with a certain personality and a certain price. Now, entering from the red corner, we have the challenger, the Schwab US Large Cap Growth ETF, ticker SCHG. It may not have the same household name and recognition as QQQ, but among savvy long-term investors, SCHG is revered for its brilliant design and ruthless efficiency. It tracks an index that scans the 750 largest US companies and uses a data-driven system to pick the ones with the strongest growth characteristics. Think of SCHG as the Moneyball approach to investing. It's not just about the most famous plays, it's about a smart system for finding winners. Its top holdings look a lot like QQQ's. You've still got Nvidia, Apple, and Microsoft right at the top, but its method results in slightly broader, more balanced portfolio. It's known for two things: delivering performance that rivals its more famous competitor and doing it at a fraction of the cost. It's lean, efficient, and incredibly strategic contender in this fight. So the stage is set. Do we go with QQQ, the high-octane powerhouse of tech, or do we choose SCHG, the broader, more disciplined, and cost-effective champion? To decide this, we need a scorecard. When you're picking an investment for life, the rules change. Short-term hype becomes meaningless. performance, you have to look deeper at the fund's DNA. For this showdown, we'll judge our titans on 3 critical criteria. The first criteria is long-term performance and growth engine. This is the obvious one, but we have to look at it with nuance. We're not just looking at who won last year, we need to see performance over a full market cycle, booms and busts included. More importantly, we need to understand the engine driving that performance. Is the fund built to consistently capture the leaders of tomorrow? A forever ETF needs a durable engine that can adapt as the market changes. Past performance never guarantees future results, but a long consistent track record tells you the strategy is solid. Now for criteria number 2, this is easily one of the most overlooked factors in long-term investing, the expense ratio. This tiny annual fee might seem insignificant, but when you're investing for 30 to 40 or 50 years, that fee becomes a monster. Think of it as a small leak in a giant ship. On a short trip, you barely notice, but over a journey across the ocean, you could lose a huge portion of your cargo. High fees are the ultimate villain in your compounding story, and for a forever investment, defeating this villain is everything. Criteria number 3 is diversification and concentration risk. Finally, we have to look inside the ETF. How many stocks does it hold, and how much weight does it give it to its biggest positions? A highly concentrated fund is a double-edged sword. When its top companies are flying, your returns are spectacular, but if one of those giants stumbles, it can drag your whole portfolio down with it. A more diversified fund spreads that risk. For a forever holding, we have to ask which structure is more resilient, which is better equipped to handle the failure of today's leaders and the rise of tomorrow's challengers. These 3 criteria, performance, cost, and diversification, will be our scorecard. It's time to put QQQ and SCHD side by side. Round 1 is performance and growth engine. Let's start with the 10-year annualized returns. Over the last decade, QQQ has been a powerhouse, delivering an impressive annualized return in the range of 17 to 19% depending on the exact time frame you measure. That's a phenomenal growth and a testament to the power of its tech-heavy strategy. So what about SCHD? Over the same 10-year period, it delivered an annualized return of 15 to 17%. It's a strong performance, though historically just a step behind QQQ. But here's where it gets interesting. In certain recent periods, like the past year, SCHD has actually outperformed QQQ. This tells us that its broader factor-based system is incredibly effective at capturing growth, maybe with a little less drama along the way. While both are fantastic performers, QQQ has a slight edge in long-term historical returns. So this round goes to QQQ, but only by a hair. Now round 2 is cost of ownership. QQQ comes up with an expense ratio of 0.2%. Now that's not a highway robbery, but it's not cheap. For every $10,000 you invest, you're paying $20 a year every year. Now, to be fair, Invesco does offer a cheaper version, QQQM, with a 0.15% fee, but for this fight, we're focused on the original. So let's look at SCHG. Its expense ratio is a minuscule 0.04%. That's just $4 per year for every $10,000 invested. Do the math, that's 80% cheaper than QQQ. You might think it's a difference of 0.16, who cares, your future self cares a lot. Let's imagine you invested $100,000 in each ETF for 30 years, assuming a hypothetical 10% average annual return before fees. In QQQ with its 0.2% fee, your investment would grow to about $1.7 million. You would have paid over $47,000 in fees. In SCHG with its 0.04% fee, that same investment would grow to roughly $1.73 million. You would have paid less than $10,000 in fees. That's an extra $35,000 in your pocket. That's not from timing the market or picking better stocks. That is pure hard cash you get to keep simply by choosing the cheaper fund. For a forever investment, this isn't a minor detail, it's a game changer. This round isn't even close. The winner by a knockout is SCHG. Now, round 3 is diversification and concentration risk. Let's pop the hood. QQQ tracks the Nasdaq 100, so it holds about 100 stocks. A key feature and risk is its concentration. Top 10 holdings in QQQ makes up about 50 to 55% of the entire fund. This means the fate of just a handful of companies like Microsoft, Apple has a huge impact on your returns. From a sector standpoint, it's all in on tech, which makes up a massive 50 to 55% of the portfolio. SCHG, on the other hand, is built differently. It holds nearly double the stocks with around 200 holdings in total, while its top 10 holdings also account for a hefty 50 to 55% of the fund. The key difference is the other half of the portfolio. By holding twice as many stocks, SCHG gives you a broader foundation. Its sector allocation is also more balanced. Tech still leads at around 49%, but it has more meaningful stakes in other sectors like healthcare and financials, which are almost absent in QQQ. What does this mean for a forever holding? Well, QQQ's concentration is a high stakes bet that today's tech giants will rule for decades. History shows us that market leaders can and do fall. SCHG's broader diversification, both in stock count and sector weight, makes it more resilient. It's still a growth fund, but it's not betting the entire farm on one part of the market. That gives it a crucial buffer and makes it better suited to adapt over a multi-decade journey. For its more resilient structure, this round also goes to SCHG. So the score are in after 3 rounds and the verdict is clear. In round 1, performance QQQ took the win, but just barely. In round 2, cost, SCHG delivered decisive knockout, proving to be 80% cheaper. In round 3, diversification, SCHG's broader and more balanced portfolio was the more resilient choice. Therefore, if I had to choose just one growth ETF to invest in for the rest of my life, true set it and forget it choice, I would choose the Schwab US Large Cap Growth ETF, SCHG. The reason comes down to the core principles of a forever investing. Are you willing to give up a silver of historical performance for a massive advantage in cost and much more durable structure? For a lifelong investment, the answer is resounding yes. SCHG gives you a powerful exposure to America's best growth companies, but in a smarter and vastly more cost-effective way. The 0.60% fee difference seems tiny, but over a lifetime it means tens of thousands of dollars stay in your pocket working for you. Its broader diversification means you're better protected from the inevitable fall of today's giants and better positioned to capture the rise of tomorrow. It's the perfect marriage of potent growth and intelligent design. Now, in declaring SCHG the winner, let me be crystal clear. QQQ is a fantastic ETF. It has made investors a ton of money for over 20 years and is a powerful tool for aggressive growth. For someone with a shorter time horizon or who wants to use it as a tactical holding to add a tech punch to an already diversified portfolio, QQQ can be an outstanding choice, but it didn't win the one ETF forever challenge. Higher fees, while competitive, creates an unnecessary drag on returns over a lifetime. When an ETF like SCHG exists with similar exposure for a fraction of the cost, the math for long-term holder is undeniable. Furthermore, its heavy concentration is a bet that's a bit too risky for a 50-year time frame. The world will look very different in 2075, and SCHG's slightly more balanced approach gives it a better chance of adapting. So much respect to the legend QQQ, but for this challenge, it's the runner-up. So when the dust settles, the search for the ultimate growth ETF leads us to SCHG. It delivers the powerful returns we want, but with the intelligent design and rock bottom cost that are essential for a true lifelong holding. It elegantly solves the problem of analysis paralysis, offering a simple, robust and effective path to long-term wealth. Now I want to hear from you. This is always a heated debate. What is your one ETF forever? Do you agree with me, or would you pick, or would you have gone with QQQ or maybe another contender entirely? Drop your choices and your reason in the comments below. I read every single one and the whole community learns from this discussion. And if you found this deep dive valuable, make sure to subscribe to the channel for more data-driven analysis to help you become a smarter, more confident investor.